Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me would be the mayor himself, Mr. Michael Becker, but he is on another due diligence assignment. So joining us, the man himself, the professor, James Eng. How are you?
Good. Thanks for having me, Paul.
So what is going on in the Old Capital world these days? Is there a speaker series around the corner?
Yeah. So, at the end of March, we're going to have Jillian Hellman, who is the CEO and founder of Realty Mogul, and have her come talk about what she's seeing in their portfolio. They do all types of commercial properties, but they do a lot of multifamily. And so she is based out of California. She is going to be joining us virtually to talk about what she's seeing in the commercial real estate space in their portfolio, and then sort of how this whole real estate crowdfunding world is developing. And so I think it'll be super interesting. You can go on to oldcapitalpodcast.com and register for that event.
She is an interesting woman because she was on the forefront of crowdfunding back probably about 10 years ago. And she's really a technology person, and with the help of a number of banks and software companies that had put capital feeding into the business, and that business has really taken off. And that's Realty Mogul. And they've invested in hundreds of apartment buildings and single family transactions across the United States. So she'll have an interesting story about the kind of the state of the market and what she's seeing today and what she sees in the future. So thanks for joining us. What's the best way for somebody to RSVP to that event, James?
Yeah, there's a couple ways. You can go onto either our Facebook page, it'll be there, or you can go to oldcapitalpodcast.com, and then we'll put a button there on the right-hand side for you to register for that event.
I love it. So don't forget, if you're on the oldcapitalpodcast.com website, download the 1718 page white paper report that James and I wrote. We've just updated it. So we're looking forward to having you read the update. We talk a little bit about COVID reserves and other things that are really affecting the market these days when it comes to financing. And if you've never owned an apartment building, and if you're thinking about buying an apartment building, this white paper report is something to read, look at. And don't forget, Michael Becker's put in his due diligence checklist, and that is very important because it's really having you get a checklist to ask the questions to the seller when you get under contract of what they should be getting. So I think that would be something good for you to have. So in the podcast today, have you thought about buying an apartment building in Atlanta? Did you want to find out what's going on with multifamily in Georgia? We have one of the top producers in the country that just happens to be out of Atlanta. He's shared some time recently with James and Clay. James, tell us a little bit about what you got.
Yeah, I think a lot of people that listen to the podcast are familiar with Texas, but we're seeing a lot of people go maybe from the Northeast to the Southeast. And so we wanted to bring Sean Henry on with Capstone, and they do a bunch in Atlanta. And I think what's interesting as we go into the conversation is we're going to talk about multifamily, we're going to talk about Class A deals, but then we're also going to talk about some of the build to rent that he's seeing develop. And then also just in terms of how people are moving up from sort of the, let's say, B and C space into the A space.
He definitely knows his stuff. He kind of talked a little bit about a thing which I never really had heard, a thing called the Martini glass of the growth pattern in Atlanta. And it kind of talks a little bit about where people are truly investing in, what companies are coming to Atlanta, what job growth is there. But he had mentioned to me in the conversation, I think 7% rental growth for 2021 is what CoStar is predicting in Atlanta. So you really do want to listen to this conversation that James and Clay Allen had with an expert of what's going on. Anything more, James, to add?
No, I think one of the things that you're going to have to learn is that as you look at these different markets and get a feel for them, really having people on the ground there is really, really the secret. So take a listen and get a feel for the Atlanta market and reach out to Clay. He is right there in Atlanta if you have any questions about financing your deal in Atlanta.
That's great. So without further ado, let's get in the conversation with James Eng and Clay Allen with Sean Henry. And thanks for listening.
All right. Today we have Sean Henry with Capstone and Clay Allen with Old Capital. And we are going to be talking about the Atlanta market. So Sean, thanks for joining. Maybe to kick it off, tell us a little bit about yourself and the firm that you're at right now.
Yeah, sure. Thanks for having me, guys. It's great to be with you today. I'll give you a little background on myself. I'm in the multifamily space with Capstone. Capstone is a investment sales firm based in Charlotte that has been expanding quite rapidly. It's a privately owned investment sales firm and focuses primarily on multifamily. We do have a manufactured housing group. We do a lot of land sales, and we have an equity solutions team as well. So we're finding equity for deals as well. My background is, basically the whole decade of the 90s. I was an acquisitions officer buying for pension funds, worked for GID for most of the 90s, and then worked for a company called Lend-Lease, which is no longer in existence, but the remnants of who I work for is now Morgan Stanley. And then in 2003, I switched over to the brokerage side, try my hand at investment sales, and have been with ARA for a good run, about 10 years, until about 2013 when I decided to open my own office with Moran & Company. And ran that office till about a year ago when I closed down the Moran & Company office and opened up the office for Capstone, which basically entailed changing the name on the door. That's about it. It was a switch that I made because the Capstone guys are much more networked within the Southeast. So that's been a great run so far. And we're looking forward to getting a lot of things going and got a lot of deals, and excited to talk to you today about the market.
I'll kick it over to Clay, and Clay, maybe take us through some questions on the Atlanta market and sort of what you guys are seeing.
Yeah, sure thing. And before I do that, Sean, it's probably 3-4 years ago, you sold a high-rise deal for us here in Atlanta. Probably one of the tougher deals I've ever asset managed, and you made a lot of our investors very happy with how you handled it. You really got into the details. Great job on that.
Thank you. I appreciate it. That is a complicated high rise with all the HOA issues and things like that. But as you know, that was, I believe, the second time that I was involved with that particular building. So I know it well now, and looking forward to selling it again in the future here in the next probably few years.
Good deal. Well, a lot of our listeners are in Texas and out west. We're building very rapidly here in the Southeast, although we already have a great presence here. Wanted you to maybe just talk a little bit about what makes Atlanta an attractive multifamily investment spot.
Sure. Atlanta obviously is a large place. I think we're about 6 million people now. So it's not the size of Houston, but it is a big city. And I believe it's in the top 10 largest cities in the country. So the real thing that drives the Atlanta marketplace is it is a central hub logistics-wise. And the logistics of Atlanta really drives that economy. And a lot of corporate headquarters are based here because of the logistics, because it's very easy to get places on direct flights in and out of Atlanta. But also, places like UPS and people that are in the logistics business are also based here for logistics reasons, whether it's ports or rail or highway or airport. All of those things sort of come to Terminus, which was the original name of Atlanta, is kind of where this is all driven from. So a lot of businesses are attracted to that, and that's really driving a lot of the economy. And what we're seeing right now, we have a lot of corporate headquarters and we have plenty of that. There's actually a lot of high tech going on right now. Companies like Microsoft are putting in lots of money. Facebook is putting in lots of money in new campuses that are being built in the Atlanta. So there is a lot of high tech going on here, which is really driven from, I don't know if this is still the case anymore, but Georgia Tech was the third ranking technology school in the country. I think it was MIT and then Berkeley and then Georgia Tech. So there's a great brain trust coming out of that, and a lot of spinoffs come out of Georgia Tech. Startups, they have all kinds of ways that they're creating new businesses coming out of that school. So high tech is really attracted here, which is driving the top end. But at the bottom end, we're seeing significant expansions in, groups like Amazon are opening up major distribution facilities here. Purple Mattress Factory just opened up, I think it's a 1 million square foot building down on the south side in McDonough, and lots of that type of employment growth going on. And what we're seeing right now, we can get into this a little bit later, but that's where our greatest rent growth on the apartment side has been in those markets that are more blue collar in nature, which have been markets, the South Side has been one where institutions have shied away from. And going way back, I would say 20 years ago, the liquidity on that side of town, which is the South Side, where a lot of those blue collar jobs are based, was a little more challenging. And if you got into a difficult investment environment, it might be harder to sell those deals or take longer. I don't think that is the case anymore. It is such a large market. It's 5.5% rent growth on the south side of town right now, which is just unbelievable. And that product down there is doing very, very well. And I think it will remain liquid from here forward, where you can trade that product going forward. So I think it's going to be a good thing. So hopefully that's a good summary on kind of the things that are driving Atlanta.
Yeah, totally. And I think you answered maybe 2 or 3 of my questions when we started talking about the South Side, but I do want to expand on that just a little bit. So, one of the things I did a quick video when I joined Old Capital, and I explained the V, or the martini glass that we often call it in Atlanta, where the institutions have typically played. And that's it's downtown connector, the interstate system that goes northeast and northwest. And then within that boundary, if you will, that's where we've always seen the kind of the Class A office and institutional capital, the smart money, so to speak. Do you think that is where we're seeing a paradigm shift? Do you think we're going to see more institutions looking at the South Side?
I do. I think that the days of only investing in the martini glass are probably over. And I don't mean to say that to suggest that is not a good place to invest. That is a phenomenal place to invest. And that's driven primarily, if you take that martini glass, it's anchored with downtown, which is about 20 million square feet of office space, which is mainly government-based businesses. But then you also have other very large institutional, decent income, but not great income, but would be like Georgia Pacific and some other companies like that. Then you get into Midtown, which is another 18 million square feet of office space, which is dominated by, law firms, CPA firms, that kind of thing. And that's a more highly paid office worker. And then you come into Buckhead, which is about 20 million, a little less than maybe 18 million square feet of office space that is primarily money managers and that type of thing. It's where all the real estate companies, not all of them, but most of the real estate companies in Atlanta are based in Buckhead. That's where the highest paying jobs are. And that's what drives the very bottom of that martini glass. And then you get out to Perimeter, which is our largest office market, which is probably over 30 million square feet of office space now. And that's where places like UPS and Newell Rubbermaid was there. They moved out, they moved back. I can't even keep track of where they are these days. But we've got Mercedes-Benz and we've got State Farm, and there's been Cox Communications. There's a lot of pretty decent employers there, but not quite as highly paid as the market down in Buckhead. And then out to the west on the left side of the martini glass, you've got Cumberland, which has been growing like a weed. In fact, they're finishing out the ThyssenKrupp building now. And I believe Papa John's just moved in to that market as well. That was, last time I checked, that was about 24, 25 million square feet of office space. So there's plenty of jobs out there as well. So those office jobs really drive that martini glass. But I think that institutions are recognizing that there are other places. This is a distribution town, and logistics is a big part of it. And a lot of the logistics, is expanding in different places, right? We've got Kia to the southwest, down 85, down closer. It's really not Metro Atlanta. It's kind of close to the Alabama border. But that car plant is making a big impact to that side of town or that part of Georgia. And really to go along with that, you've got the distribution. I really view 75 as the connection between Savannah and Atlanta. And you're connecting the airport to the seaport. And that's where a lot of this growth has been. And there's a lot of buildings going in there that are distribution facilities. It just so happens that it's flat down there as well. So it's easier to build a 1 million square foot building, which is almost impossible in, say, Vinings.
Right.
Can't find enough land to put one there. You'd have to chop off the top of a mountain. So that's really what's driving a lot of that. And you see things like, Commerce, Georgia, up in the Northeast, they're putting in a 2 million square foot building right now that is going to manufacture batteries. And a lot of the batteries are going to be fed to all of the auto manufacturers. So down in the Southeast now, we've got, there's Mercedes-Benz plants, there's BMW plants, there's Volkswagen plants, there's Hyundai, there's Kia. All of these places are going to have a need for these batteries that are being built in this. I drove by it on 85, and a 2 million square foot building is probably the largest building I have ever seen.
Yeah, it's massive. I've seen the same thing. James, did you want to ask a question?
Yeah. Sean, can you give us an idea? So in DFW, let's say an A-class deal is 200 a door. A B-class deal, let's say, is 125 to 150 right now. C-class is probably 100 a unit. And then we're seeing those deals trade on the A side, probably around 4% cap, B's 4.5%, and then C's 5%. Let's just say roughly. Can you give us some general parameters in the Atlanta market, what you're seeing right now, sort of across class in terms of price per unit and cap rates that you're seeing?
Yeah, so that's a great question. Based on the numbers that you just threw out, I think that Atlanta may be a bit more expensive than Texas right now. And, look, in our market, we've had 3.5% rent growth in the past 12 months during the middle of a pandemic. We've also had our vacancy has dropped by 1% during that pandemic. So we're going gangbusters. Our employment is down less than 1% from the beginning of the pandemic. So our employment hasn't really slipped that much. And then looking forward, our construction pipeline has dropped off by 6,000 units. So it went from roughly, 17,000 units were under construction. That's not an annual number. That's just everything under construction. The development cycle takes a little longer than a year. But it went from about 17,000 units to we are just over 9,000 units today. So there's been a significant drop off in the development pipeline. So going forward, that looks even better. And there's still, like I said, Microsoft and some other major companies are moving here, not to mention all the smaller companies that are moving here. I think there is a desire to be in this area from the Northeast. So where am I going with all of that? All of that says that if you look at even CoStar, which I have never seen in my life, but they are projecting that rent growth in the second quarter of next year will be 7%. So 2021, second quarter would be 7%. So that is unbelievable. Because all of these economic forecasters always predict 3%. That just seems to be the easiest way for them to go. So I think all of that, to get back to your question, is there's a lot of optimism about where this market is going, and cap rates are pretty low. I was working with a client last year on a Class A brand new but stabilized property that had some retail in it, and it was a really nice looking building. And they had an offer from a very serious buyer that was in the 3.5 cap rate range. And they turned it down. That's because everybody knows, where are you going to go to find solid real estate today? And what are you going to have to do to win the auction process? So it becomes very, very difficult to replace that asset. And so they turned it down. So I would tell you that the Class A space is certainly in the 3.5 probably range for deals today. We see high rises trading we've had some trade at 600 a door. There's a rumor that there's one in the market right now that's under contract that that might trade close to $1 million a door. That's a different asset. It doesn't have any one bedrooms. It's all two bedrooms and it's doing quite well rent wise. But it does go to show you that people are willing to pay up for deals in Atlanta. Now on the moving down the chain, we just sold a 70s vintage deal in Augusta, Georgia, for a 4.2 cap rate. That was under $100 a door. We've got one in Gwinnett County under contract right now that is about $160 a door. That is early 80s vintage deal. That again is kind of mid fours. So when you say 5 cap rate for C product, I'm going to tell you that it's pretty hard to find 5 cap rate in Atlanta right now.
So Sean, real quick, you get a phone call from someone out of state. They're looking for, let's say, 100 to 200 units, value add. Where are you going to point them to? What area of the city, maybe to kind of focus?
Yeah, there's a lot of different places in the city where you can go to try to find that type of stuff. You're going to have to pay up for it on a cap rate basis, but that rent growth that I talked about being 6-7% from CoStar. That's a market-wide number. So that's not specific. I would tell you that if you're looking to make that investment, I would be out anywhere in the suburbs, any kind of location like that where you can find that older product, whether that's up the 75 corridor, the 85 corridor, 400 corridor is going to be extraordinarily expensive, or even on the south side, down 85 to the southwest or down 75 to the southeast, even 20. Look, out on the east side is where Facebook is putting in their campus out in Covington. And so there's been a lot out there that they have a couple biomedical things going in out there where they're going to manufacture some pharmaceuticals. So those areas will do well. Douglasville out to the west, another logistics hub out that way. So, I would say I'd stay away from Midtown and Buckhead. They are still swallowing a little bit of their supply, and it is more challenging in the in-town locations. I don't think that's different from most other cities, but our rent growth has been the most difficult. Like 3.5% market-wide for the whole market, and you got places like Henry County that have been 5.6, I believe it is. So you've seen really good rent growth in those areas. So how do I offset that to get back to 3.5? Well, it's Midtown and Buckhead. They're much, much lower rent growth. In fact, I just did a study yesterday where I was looking at all the high rises in Buckhead, and pretty much if you were built before 2017, you maybe have a stabilized occupancy above 90. Mm-hmm. There is almost nothing that has been built since 2017 that has an occupancy today above 90. In fact, The average is about 15% vacant, and a lot of I can point to 3 or 4 off the top of my head that are about 30% vacant.
Yeah. So for the listeners, I mean, if you're planning to buy in Midtown Buckhead area, just be prepared to be offering a month to 2 months free for probably your whole period. It just seems to has always been their concessions, but there's job growth, obviously a lot of great stuff going down there. So what should a buyer be prepared, or what kind of terms should a buyer be prepared to come with if they're able to lock a deal down?
Yeah, if you're buying a B type asset in the suburbs and it's going to be a value add play, that's probably going to be a hard cash up front type of deal. And the faster, the better. There's so much competition for that type of a deal. It's extremely hard to find. If you move into the C, our kind of 70s vintage deal in Gwinnett County and our 70s vintage deal that we just closed in Augusta, which Augusta, by the way, for those in Texas, is not a suburb of Atlanta. It's an hour and a half away, 2 hours away. But those are not hard money kind of deals. They're not, hey, I'm going to put up a hard deposit of $500,000 day one or anything like that. That's not that kind of a deal. So when you move down into that quality of product, that's not going to be required. And then when you get up into the A space, I think terms become, when they're institutionally owned like that, terms are a little bit less important than actually knowing that the buyer is capable of performing and will perform. So reputation becomes a really big deal. But, I'm not sure that, the very, very largest of the owners So you put up money hard, it doesn't always make that much of a difference with them. So I don't know that it's required, but you're going to have to prove that you can get those deals closed and at very low cap rates.
Got it. So James, did you have anything else? Any questions?
Yeah, talk about, what we've seen, and I don't know if you've seen enough transactions yet, but we've seen just at the beginning of this year, interest rates run up a little bit. And that has sort of impacted the leverage on Fannie and Freddie, as those interest rates that Fannie and Freddie are charging are pretty close to those cap rates. I mean, if your cap rates are in the 3.5 to 4.5 range and your interest rates 3.5 to 4, it becomes pretty tight. And so in Dallas, we've got a little bit of a spread there, maybe 100, 150 basis points between your interest rate and your cap rate. And so what we're seeing is leverage is coming in a little bit lighter. So in the 60%, 65% range on B and C deals, whereas previous, they came in at 75 or 80. And so we're seeing a lot more people maybe use a bridge loan on some of these deals. And so I'm just interested in seeing, how are people putting the deal together? What type of debt are they using? And then how are they structuring equity? Most of the investors we work with it's sort of syndicated equity. So they, reach out to friends and family, maybe a larger network that they have, and go raise, 75 to 100,000 from accredited investors. How are you seeing your deals put together on the debt and equity side?
Yeah, I would preface all of this by saying that there is an unbelievable amount of capital out there today. And I think that that's only going to increase the amount of capital that is available for investment. So if you're buying a deal and somebody says 65% versus 75%, it's almost like, who cares? Because there's plenty of equity to fill that gap. Almost all buyers have that. We are seeing more like 65% LTVs from the agencies, and that's what people are moving ahead with. I have not seen it manifest in a rise in cap rates here. And I'm not really sure if they've settled back down a little bit or not. But I have not seen much of a rise in the cap rates that people are paying, but it may be too early to get that. But we did just recently close a couple deals, and they were, like I said, we did 4.2 cap in Augusta, Georgia. So we've got lots of money, lots of buyers. I think on the high end, really large pension fund advisors are more than happy to come in with all cash and just skip the whole debt process. Insurance companies, that kind of thing, they're willing to operate on an all cash basis. So I don't think that that's going to impact that much. But I think your question is a very good question. And I don't really know what's going to happen over the course of this year, right? They're saying that there's now caps on Freddie and Fannie. And once that gets spent, the market's going to be different. Does that mean the CMBS space moves back into multifamily? I don't know. I mean, it could be. It could have something to do there. But it's too early. We haven't seen it happen yet.
Yeah, CMBS would love to be in the multifamily space a ton, but Fannie and Freddie are so dang competitive that it becomes hard. I mean, you call on a lot of owners, and so when you're talking to them, what are the major concerns in Texas? The two big things that every owner is complaining about to me is real estate taxes, and they have no idea where insurance is going. And so talk to me about, when you're calling on owners, what are their major concerns, whether holding or selling?
Yeah, I would say that that's probably a national concern. Real estate taxes is by far the largest line item on multifamily expenses. When you look at your operating budget, it's just unbelievable. I remember in the 90s underwriting real estate taxes at $500-600 per unit, and it's now seems like a C quality deal is $2,000, and A quality deals can be over 10, which is unbelievable, but it's real. So that is certainly the biggest concern, is real estate taxes. I don't hear insurance come up as much in Georgia. For the people in Texas, Atlanta metro area is 1,000 feet high. So it is not, it's not a low-lying area. It may be the highest metropolitan area east of the Mississippi. It's very high up there. And by the time any of the hurricanes that hit in Florida, or even the coast down in Charleston or anything like that, even if they are pointed towards Atlanta, they got an uphill road to get here. And by the time they get here, they're not much. So we don't have snow. We don't have hurricanes. We don't have earthquakes. We got a lot of fires. That's the big thing on insurance. But, insurance doesn't seem to be as much of a concern in the Atlanta metro area.
Is there anything you're seeing, obviously rent growth has stayed consistent in Atlanta and it's forecasted to still be strong. In some of these markets that maybe rental growth is not there, is there any interesting sort of other income items or expense reductions that you've seen owners implement on, you go on a lot of tours of properties, anything interesting out there that you're seeing maybe that's a little bit more cutting edge for this space?
I don't know about cutting edge, but, package rooms are certainly a big thing that we're seeing a lot of now. Everybody's wrestling with that every day. We have seen in-town markets like a Midtown and Buckhead start to charge for parking. That's been a big revenue generator, and I think it's a good one. I think as a major metro area, we should be charging for parking, but it's just not the way Atlanta was built. So it's a little unusual, but you are seeing that now in Buckhead and in Midtown. Trying to think of any other revenue generators that I've seen that have been, that creative. And I can't think of any off the top of my head. Those are probably the latest ones that have come into play is parking. And I think, to be completely open and honest about it, I would suspect that parking charge in Buckhead and Midtown may be tough to get today because they're just trying to backfill, when they're dealing with their own occupancy issues, they're dealing with soft rent. They may even be dealing with some concessions in certain sub pockets. But so I think that was going into the market before the pandemic. That was where they were adding a lot of revenue, but it's probably being used as a closing tool right now.
Okay. Yeah. I mean, in Dallas, what we're seeing is a lot of people go into sort of the smart apartment or smart home sort of package. So you walk in, it might be a keyless entry, it might be a smart thermostat, it might be how you control all your lights, that type of stuff. We're seeing some people implement that just because, like during COVID, like the leasing office was closed, right? So you're doing all your payments online. And so if you just sort of had one portal for people, it made it a little bit easier. And mostly we're seeing that maybe in the A-B space. It hasn't really crept into the C, but if, as a C renter, you walk in and you've got a smart thermostat and keyless pad. I mean, it's pretty cool. So maybe talk about some of the listings that you guys either have out now or have recently closed, and then we can sort of wrap up with sort of how people can learn more about those deals.
Sure. We've, like I said, we've got one under contract right now up in Gwinnett. We just closed one in Augusta. This is an interesting side note as well, but we started last year a group called the Equity Solutions Team, and we help developers and owners find equity to capitalize deals on the equity side. The majority of that has been development, and I've done quite a bit of this in the past, where I've helped developers build a few deals here in Atlanta and even recapitalize deals where they had partners. And then the partner wanted out, but the developer wanted to hang on. I've helped them replace that capital. So we closed the deal on the south side last year called the Columns at South Point, where I sold the land to ECI and then also helped ECI capitalize that project with an equity partner. That deal's under construction now. The Equity Solutions team that I'm on is market agnostic. So we go everywhere. We recently closed a deal in Denver, Colorado, and that deal should be starting construction later this spring. We are calling for offers this week. In fact, we've already got a bunch in here, watching them come through on my email now, for a deal in Charlotte called the Wayford at Innovation Park, which is a brand new to-be-built townhome development for rent. So I guess I would say we've also got a deal in Richmond that is getting close. I'm working on a deal in Massachusetts, probably got a couple deals coming up in Florida. So we've been around with that Equity Solutions team capitalizing new deals. I do think that there has been a national pullback in development. I think as the vaccines get disseminated and people get them, we're going to see that development pipeline pick back up again. There's a lot of interest. We closed the deal, the columns at South Point in July last year, which was an extraordinarily hard time to get a deal done, a development deal going. But that deal is going to do really well because no other deals are getting built around it. But I think we're going to start to see the development pipeline pick up. I wanted to just mention the Wayford at Innovation Park being an all townhome for rent deal has got a tremendous amount of interest. And I cannot get through a week without talking about build to rent single family, which that townhomes is similar to that. It's not the exact same product, but that product is a new thing. It's going to be here to stay. I think people that are questioning it need to realize that that's coming. I think they threw gasoline on that idea with the pandemic and people saying, hey, I can't live in such a small space. I'm actually going to work from home, a lot more now, which I don't think that trend is going away either. I think people will start to go back to the office, but I don't know that that's on a 5-day-a-week kind of plan. So I think people will be planning for having space at home, and that pushes that build to rent model. It's unbelievably strong here, which I'm assuming is in most markets, but in the Southeast, it's really, I can't get through a week without talking about it.
So I want to go through two questions that came up to me on the build to rent space. Sort of pre-COVID here in Dallas, there was maybe one developer that sort of came to market with that product, and what gave some people some heartburn, and maybe you can touch on this, is just really the price per door that it was going for in comparison to a Class A deal. So these were in nice suburb areas in Dallas, and it was like, let's say $250 a unit or $300 a unit, because it was like, individual houses in a community of, 150 of them. And then nothing was that expensive in the market, right? Like a Class A deal was 150 a unit in 2018, 2019. And so when people were looking at 250 a unit, like that gave people a little bit of concern. So like maybe give us some numbers in comparison to that market on that build to rent, sort of how you get sort of what you build it at essentially, and then what you plan on selling it roughly.
So the biggest concern that I have bumped up upon in marketing that type of product is when people take a look at how does this rent compare to the area income, the median area income and this rent, and how does that work? What I think people have to realize is that there's segments in everything. And the way I put it to people that are looking at that is I say, okay, so if you're going to compare your rent to the area median income and you want to do development, so I will only send you all 1-bedroom apartment properties if that's what you're looking for. That's not the right way to look at it. You have to look at the segmentation. What a lot of these deals are building, and the Wayford at Innovation Park in Charlotte is a great example. It is all 100% attached garages. It's all townhomes. There are no 1-bedrooms. So when you factor in the fact that you've got attached garages, you've got your own unit, they've got little backyards fenced in so that if you have a dog, you let them out right there. All of those things combine to make it apples and orange when you're comparing it to an existing apartment community. And you have to factor that in. It's not even like you can't break that down by rent per square foot or even the chunk rent. I mean, if I had an apartment community and I was renting an apartment and somebody came in with a dog and I said, well, this unit over here has a fenced in backyard, that person could pay $300 more a month just for the fact that the backyard's fenced in. So, I mean, when you look at it that way, it's really, really difficult. And so you have to really recognize that the rents are going to be higher. They're going to be stickier tenants. The turnover is going to be lower. You're going to have less maintenance costs going forward because of all of those things. It just drives to a better NOI. And at the end of the day, people that are putting out capital are really only looking at return. So you just have to be ready for the fact that this product is going to be more expensive. It's a different product. And I think that the tenants have shown that they're willing to pay for that.
Absolutely. And then sort of stepping back to the development equity, what we've seen is a lot of like crowdfunding sites and things like that have a lot of development deals out there, right? And how do you talk, and maybe it's just a different investor, like a lot of value add investors have grown up like sort of, all right, I got day one cash flow. I'm going to go in, do 5,000 a door in rehab. I'm going to raise it from an 8% or 7% cash on cash, and I'm going to get it to a 10% cash on cash, and I'm going to exit in 3 years. And how do you now say, all right, you have no cash flow for 3 years, and then we're going to sell it on the back end. Let's go. Like how do, or maybe it's just a different investor, and maybe they're just trying to put out more money, right? So a lot of the BNC stuff, the equity checks are probably, 5 to 15 million. On these development deals, it might be a $30 million check. So maybe talk to me about sort of that piece of the stack, I guess.
Yeah, a $30 million check would be a very large development deal because you are going to get construction financing on it as well. Right. I'm not saying that we're not looking for that on some deals, but they're typically going to be more like a $15 million. Our smallest was probably $5 million equity check. But so that's kind of a relative size. But I will tell you that it is interesting. The groups that raised a fund that say, I could do development in my fund. I've got an allocation where I can do 10% of my fund in development. Boy, that's tough because I've got a database full of investors that only want to look at development deals. They are 100% focused on it. And they've gotten smart about it. It's a different investment. It's a different criteria. You're looking at a partner. You're looking at the financial backing of that partner, who's standing behind the guarantors. All that kind of thing is a lot more complicated. How do I get through a tri-party agreement with the construction lender? It's a different world. And so I think that for the most part, what I've been dealing with is buyer or investors that are 100% focused on that. Now, how do they get through, particularly on a private investor who is a high net worth group that promised a cash on cash return? Not going to work. This is not their kind of deal. Having said that, I will tell you that there are funds out there that are set up for development that will pay their own current pay rate. So it's the same as a construction loan, right? They'll lend you the money to go into an interest reserve, and then you pay them back the payments based upon that interest reserve. Same thing. So if somebody needs a 6% current pay rate, I don't even know that it factors into too much of the decision with the developer because they're just giving you the money to pay it back to them. Right. So at the end of the day, but I will tell you the interesting point that I would bring up is when the pandemic hit in March, equity shops shut down. And they were like, we don't know what's going to happen. Is anybody ever going to pay rent again? What's going to happen? And there was no equity available for development deals for probably 3 or 4 months. And during that time, all the capital shifted to preferred equity. And that was, you're lower in the cap stack, you're taking a lower risk. Your return is guaranteed by the developer's return, which is completely 100% subordinate to your return. So that's where it shifted. But I'll tell you right now, it's gone back the other way. The majority of offers that we already have probably 10 in hand for the deal in Charlotte. The offers are due today. We're probably going to end up with close to 20 proposals for that deal. The majority of them are true equity, 90-10 equity splits type of deals. So that's been a huge shift since last summer, really. So we're seeing a lot more of that. But I would tell you, the answer to your question is most of these shops, I got a whole database full of guys that only want to do development deals.
Well, Sean, I really appreciate you coming on today and really diving into some things that I did not prepare you for. So thanks for sharing your knowledge on build to rent and sort of equity development, all that type of stuff. So anything you want to wrap up with, and then, what's the best way if someone's interested in one of these, whether it's Atlanta, whether it's value add, whether it's development, whether it's equity, what's the best way for people to reach out to you?
Yeah, sure. My email is Sean, SEAN, at capstone-companies.com. That's the easiest way to get in touch with me. Everybody seems to work a little bit better with email these days than anything else. So anybody feel free to get in touch with me. Capstone is a growing company. We're getting into a lot of different things. We've got an amazing manufactured housing group. The Equity Solutions team we're working on a ton of stuff, really getting into that development world with that. We just opened an office in Denver and in Colorado Springs and Oklahoma City. So we're expanding, we're growing, we're doing a lot of business, and we'd love to help anybody out with what they're looking for in multifamily.
All right. Thanks a lot, Sean. Thanks, Clay, for jumping on today.
Yeah. Thanks so much for having me, guys.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.